Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com. Welcome back, Real Estate 360 Live. This is Ryan Sloper. I'm your host, joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate 360 is designed to build the Washington, D.C. Metro's market by giving you good free advice. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is our off-air number. It's 877-245-2030. That's 877-245-2030. And remember, that's the off-air number. When you call, please leave your name and phone number, and we will get back to you by the end of business today. You can also reach us via the web at realestate360live.com. realestate360live.com. There's an Ask a Question button on the right-hand side. Feel free to drop me a line or email there if you have any questions regarding credit repair, whether it's refinancing, buying a home, getting your credit fixed, whatever it may be. I'd be glad to help you out with that. Before we went to break, we were, discussing the Fed and the implications that they have or the repercussions that their statements had on actual interest rates. And it's interesting, Louis, because, HARP 2.0, which is the Home Affordable Refinance Program, which is soon to be implemented across the board with all these lenders, probably within the next couple weeks or so. It's supposed to go live. I think it's awfully interesting that at the same time that this is getting ready to be implemented, interest rates are rising back up. So it's going to offset the amount of people that actually would be able to take advantage of this and be able to actually have a significant savings to do so. You know what I mean? It's almost like it's perfectly timed.
Perfectly timed to achieve nothing.
Right, exactly. So it's like, all right, well, let's go ahead and offer this program, but then if interest rates go up slightly, then there'll be less people that can take advantage of it. So really, in the end, it was a wash. People will actually think that we were trying to do something, but we offset it by, letting interest rates rise back up.
It shows that basically governments and the Federal Reserve really cannot manipulate the market to achieve the desired result, because if that were true, if money printing did the trick, then everybody would be rich. You just print up money, hand it out, and everyone would have no more monetary issues.
Yeah,
and work.
And I believe it was in the newswire today that China is actually seeing a substantial decline in home prices and a decline in steel sales and stuff like that going on over there. So it looks like they're getting ready to witness a pretty substantial downward spiral as well.
Sure.
So, no country is immune to what's going on. And typically, the effects of what's going on in the printing here in the United States has international ramifications.
Oh, we export our inflation.
Yeah.
We're able, if you look at the countries that experience hyperinflation, Weimar Republic, Argentina, Hungary, in the past century, they were because they were localized currencies, and when you print up the money, the impact is immediate. The United States gets to work worldwide its magic with the printing press, so it doesn't really hit the United States as quickly as it would if you were in a small country with a limited currency supply. But basically, because the U.S. has the reserve currency, it can export that inflation worldwide and kind of, dilute the impact of the inflation. But when it hits, it's going to be massive.
Yeah, and and who it's really hitting the most right now is the the lower class people that are not making like minimum wage. Minimum wage probably it doesn't really go anywhere right now. It probably barely pays for the gas to get to the job.
Sure, you don't have any wage inflation right now, but you have price inflation. So you have a double whammy. You don't make any more money, but things cost more. And the things that cost more, food and energy, even though they don't necessarily raise the entire CPI, those non-core items are the ones where, especially the less money you make, they make up a greater percentage of your monthly household budget.
Absolutely, and those are the ones that are stripped out of their calculations.
Correct.
We're going to jump into this week's Market Movers, which is brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. Go to HomeGain.com today to see what I'm talking about. All you have to do is type in your home address, and you'll get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free. Check it out today at HomeGain.com. This week, there's not much data for the markets to think about. So for those of you out there that are trying to contemplate whether you should lock your interest rate in or float. I want to say that from last week, the bank rate national averages on the 30-year fixed this week are like 4.08%, which from last week was 3.88%. So it's almost a quarter higher than it was last week. For those people out there, like I said, that are sitting on the fence, remember that the markets are very, very, very volatile right now, and any news to the negative that gives the stock market more room to accelerate is going to be bad for mortgage interest rates. I've been saying this for a while now that I was worried that something like this was going to happen, and not, Lewis, it seems like there's a lot of momentum now that can really start to swing interest rates back up. Now, I'm not saying they're going to jump to 5%, but what I think is going to happen is they're going to start to go and moderate out at around like probably 4.25% to 4.5% at some point in the next 6 months.
Well, the real disaster would be, Ryan, if there is a healthy correction in the stock market, and then the Fed decides to add more liquidity as well to prop that up. That's going to end up really crushing the market, and it would be just another example of, and you can expect them to do it, of trying to fix normal market corrections by printing up money and throwing it into the system.
Right, thinking that they can correct the problem. It was
interesting. They did it with long-term capital management in 1999. They keep doing it on a greater scale as we move into, now they're bailing out countries and they'll bail out stock markets. And the way you bail out isn't through any magic. It's just through printing up money and putting it at the system.
It's our government basically thinks that the Fed is the answer to all problems. It seems like all world problems can be solved by the Fed.
Right, and if you remember the whole media fawning over Greenspan as the Maestro because he'd engaged in that type of activity, and now Bernanke's put it on steroids.
Yeah. And it was interesting. You had sent me an article as well that was titled "America Mortgaged at an Adjustable Rate" by Peter Schiff. And what he had said in this is that the Fed had ran another stress test on all the major financial institutions, as determined that 15 of the 19 tested are safe, even in the most extreme circumstances. An unemployment rate of 13%, a 50% decline in stock prices, and a further 21% decline in housing prices. The problem is that most important factor that will determine these banks' long-term viability was purposely overlooked, which is the interest rates. What he references in this article is that the stress tests were based around keeping the federal funds rate around near zero. Well, that's not a very good stress test when the average has been around 6%.
Historically, right. And even if they do try to keep it down there, they're printing up more money and they're going to create a greater inflationary event down the road.
So in essence, really what's going on here, Lewis, is that the Fed doesn't have a choice but to keep interest rates low if they're going to continue to bail out these big banks. Because that's really...
Well, in a sense, it is a way of bailing out the banks without having to bail out the banks by keeping interest rates low.
Right, without physically having to go out and say, hey, we're going to give Bank of America another $50 billion.
Right, and you think about what they do. It's the same with the budget. They say, well, my budget, politicians say, well, my budget will cut the deficit. They assume growth rates that are not even close to reality. They go, if the economy grows 4 or 5, 6%, we'll grow out of it. But the economy isn't going to grow 4 or 5% in the next few years. And they assume, in this example, they're assuming interest rates are going to remain low.
Right. Yeah, and it basically said that if interest rates were to go back up to the 6%, that all these banks would fail.
Absolutely. And then, of course, the economy would come cratering down. But as many of us have been saying, that's probably the best thing because when it comes down, you want it to come down from 100 feet, not 200 feet, not 300 feet, 400 feet. It needs to crash. Eventually it's going to crash, but you want to make sure that the crash isn't from the highest level. But they appear to be willing to go higher and higher and print more and more money, and creating a bigger and bigger problem down the road.
Right, and at this point, it almost seems like, it's just...
already too high.
Yeah, it's too high, and it's just like, okay, so we'll just keep devaluing until ultimately our currency, it's going to have to become extinct at some point because it's not going to be worth anything. They're going to have to tie it to something else. We just can't keep going and going and expect for nothing to happen. I mean, at some point, people are going to realize, hey, this paper's not worth anything. What am I doing with it?
It's simple. People don't view money as they should. It's like any other commodity. The more plentiful it is, the less demand there is for it, so the value of it is worth less. Not worthless meaning it's not worth anything. It's just worth less. For each additional dollar you put in the circulation, it makes the other dollars in circulation worth less minus that one extra dollar you put in. And when you add in that they're putting trillions of dollars into the system, that means that the existing money supply is worth less.
Yep.
And that's what drives up. And then people don't realize it's not problems in Iran that are causing oil to go up. It's basically there's more dollars chasing the same commodities. That's why commodities are going up, gold and silver as well. And, if you think about it, gold and silver have gone up every year for the last 11 years.
Yeah.
That's only because for the last 11 years, we've printed more and more money and put more and more money into the system.
Yeah, you, Louis, you had sent me an email last week where it was basically a comparison of Berkshire Hathaway versus gold and silver, and I think that this is an awesome illustration to kind of show you really how stable of an investment gold and silver has been. Wouldn't you agree?
The reason it's stable is only because they're printing more and more money. It showed that Berkshire Hathaway has been outperformed every year by gold and silver for the last 11 years, despite the chest thumping of Warren Buffett that gold is a barbaric relic and you can only fondle it, and even then it's not that much fun. I mean,
I'm convinced.
If you look at the numbers, then he's gotten beat badly by people who invested in gold and silver bullion.
Well, I'm convinced that he's tied in on this whole, the Obama campaign, which is also somehow tied into the Federal Reserve. And it all, to me, is the Fed doesn't want to recognize that, gold or anything is a sound investment because that would make their whole game plan that they have going on just go awry. But
well, sure. If you look at Buffett's whole nonsense on the taxes that somehow his secretary doesn't pay, his secretary pays more than he does, that's not true. His income comes already where it's been taxed at the corporate level at the highest rate in the world.
Right.
And so it's nonsense, but he seems like he's almost a paid shill for the administration, and it makes sense because he was bailed out in 2008. Most of his companies would have gone under, AIG and a few others, if there hadn't been the massive bailout. So in a way, his wealth now is tied to being in bed with the government and making sure that his investments receive the proper attention.
Yeah, and in fact, it was actually showed, I think, that Buffett's companies actually owe the IRS money at this point.
Well, that's the other thing. He's telling everybody they should pay more tax than the rich have been coddling, but he's got a dispute going on with the government that's been going on for about 8 or 9 years where he hasn't paid his taxes. Yeah,
absolutely. Well, we're coming up on
in fact, in his Berkshire Hathaway annual report, it mentions that the result will probably be they owe those taxes.
Yeah, exactly. We're coming up on a break. When we come back, we are going to jump into why so many errors are on credit reports and what can you do to prevent that from happening to you when we come back.